John, good morning. Thanks for joining us on the podcast today.
Hey, Carlos. Glad to be here.
I want to kick off with your take on what's happening with the CFPB. So I'm not super plugged in there, but I see all the headlines on cost reductions, people leaving the organization. And I think I even saw a headline of 90% of the staff is no longer there. What impact do you think that's having on lead gen as it pertains to lending?
Yeah, no, I think it's going to have a lot. And I think that you're already seeing some of it like in actual work product, for lack of a better term. Earlier this spring, the CFPB said, hey, all these regulations and informal guidance, we're going to pull back. And included in that was some informal guidance around steering in financial services products that aren't mortgage. And that made sense to me because that guidance was an expansion of the steering prohibitions that are in RESPA for mortgage, right? And under RESPA, a loan officer can't steer you to a product that they're getting paid more for. And the CFPB came out with something about lead generation for that on the digital mortgage marketing side. And then a year after that, they came out and said, oh, this is going to apply to all financial service products that we regulate. So personal loans, auto loans, things like that.
Got it.
What was interesting is like that is such an expansion, and they put it under their UDAP umbrella, right? Which I always like to tell people everything is UDAP. So they were kind of just expanding that. But when they rolled back some of these informal guidance, that was one that they rolled back. They did not roll back the digital mortgage one, but again, like I said, that actually has some statutory like teeth in it, right? But because of the RESPA steering. So I think we're going to continue to see things like that are, let's say, deregulation, right? In that space, especially in that informal area. But I don't know that we are going to see them come out and say, oh, by the way, we're going to get rid of RESPA altogether.
Got it.
I've heard some rumblings that they want to get rid of the LO comp rule on the mortgage side, which would be interesting.
So say more. What's that rule
So the
entail?
LO comp rule is how much lenders can pay loan officers for
Got it.
certain loans and things like that. It's somewhat tied back to that steering thing, right? Like, hey, if you sell a high interest loan to a borrower, maybe you make more money, right? And that kind of came about when there were RESPA changes and the Truth in Lending Act changes came about around that same time. And so that a rollback there would be interesting, but I don't know that it's going to happen. I've just heard rumblings of that. But
Got it.
I say all that to say, yeah, I think we're in an era where this is going to change some. And I've been in lead gen for about 10 years at this point, and I've always said that if you're just a marketer, like your regulator is your client's regulator, right? Because what's going to happen is you're going to go drive traffic and you're going to sell these leads to a mortgage company, an insurance company, a personal loan company, right? And they're responsible for the advertising. Therefore, you should care about what these regulators are saying, right? So even though maybe the CFPB couldn't come down to you and say, hey, John's lead gen, you're doing this wrong. Your clients can, and the CFPB can come to your clients and say, hey, you're doing this wrong. So it's an area in the lead generation space that you want to pay attention to what those regulators are doing, how they're changing it, because the downstream effects of those changes will be to you, right?
You mentioned RESPA and you
Yep.
mentioned kind of this non-steering thing. I want to just kind of linger there, unpack that a little bit. So as far as RESPA, my understanding is part of the intent, or maybe most of the intent, is the non-steering.
Mm-hmm.
So the way I understand RESPA is lenders cannot pay lead generators at the bottom of the funnel. Why is that? Like why is, and like, I guess walk us through RESPA. What exactly does it say, and how does that regulation connect to the outcome of non-steering?
Sure. So, let's look. go back in time, right? RESPA stands for Real Estate Settlement Providers Act or Practices Act. See, I can't remember, but it's RESPA. Everybody just calls it RESPA. So the main thing in RESPA for lead generators is there's a rule in RESPA that prohibits kickbacks for mortgage. Okay. And it basically says if someone provides a settlement service or a mortgage, the lender cannot provide a kickback to that settlement service provider. Okay. Now, what does that mean? It basically means what we're trying to stop there is uh, loan officers getting kickbacks from the lender or a broker getting a kickback from a lender, uh, a title company paying mortgage companies for business, right? There was a RESPA case from the CFPB, I think it was last year, about that. Their title company and the mortgage company were going to baseball games together, right? And CFPB said, "Oh, that's RESPA violations. Those are kickbacks. You're doing it you're giving something in value in exchange for business, right? That's a kickback." And what's interesting about that is, I think a lot of people saw that one and were like, "Well, everybody does that. Like that's the world we live in." But that CFPB said that was a RESPA violation. But let's go back to lead gen. So how does this affect lead gen? So if we're going to go all the way back, if you can't do kickbacks, how does lead gen work, right? Because that's what we're doing. We're paying for leads, right? Well, I think it was 1991. There was a Housing and Urban Development opinion letter. Okay. HUD did RESPA before CFPB did. Okay. So HUD had an opinion letter that basically said you can buy customer list from a provider, and that's not a kickback. Like that is a legal activity. Buying a customer list, you're going to send me 100 people on that customer list, and I'm going to call them, right? But I'm going to pay you per person on the list. So I'll give you $100 for 100 people. I'll call them. That'll be my list, right? Fast forward to the internet time period, and a lot of lead gen companies hung their hat on that letter, right? And saying that, hey, all we're doing is selling a list. We're just selling them one at a time when the consumers come in. We're gathering the information, we're selling the list, you're paying us a per lead fee. It's not a success-based fee because that could be a kickback, right? And that because you're not paying that success-based fee, this is just the modern version of buying a list as stated in a 1991 letter from HUD saying it was okay. And that's basically how the world worked for, call it 20 plus years. And the CFPB, I referenced it earlier, I think it was in 2023, uh, did the digital mortgage comparison shopping letter saying, hey, we want to avoid RESPA problems in this, right? And that guidance actually quoted that 1991 letter and saying, everybody relies on this. Maybe that's probably still good law. We're not saying it's not good law, but everybody's saying that this is what this is. But if you're doing a pay to play scenario, right? And the example that they used was, let's say, even a click wall and placement on the click wall is based off payment.
Mm-hmm.
That is steering. That's what the CFPB said. And Carlos, you and I have been in this business long enough to know that that's how every world works,
Yep.
right?
I have questions for you about that for credit cards, etc. But we're talking
Yeah,
mortgages now, so
yeah. So
I'm gonna hold questions for now.
yeah, so
But let's stay with mortgages.
in the mortgage space,
Yeah.
that caused a real issue. And like people I knew and companies I know well, were like, "Hey, this is a problem. How do we fix this?" And the way to do it, to fix it, was to create what they refer to as a neutral scale, right? Something that's not payment related or a proxy for payment relation, right? Is to sort based off that. And it could be interest rate. It could be, um, you could make an argument close rate.
Mhm.
You could make an argument that you could come up with a John and Carlos scale for matching, right? As long as it wasn't price based or a proxy for price. Now, proxy for price, as you and I both know, can be a lot of things, and even close rate could be, right? But that is uh, kind of where lead gen and mortgage and RESPA stand together. Now, going back to the one we mentioned earlier that they rolled back in 2024, they came out and said, hey, uh, all that RESPA steering stuff, that applies to credit card and personal loans and all that as well. And that's the one they have rolled back within the last, you know, 90 days. But that is kind of how we all evolved here, got here. And like
Hmm.
that's a big problem. As you know, it's
And what did they call that? Did they call that rule anything in particular? The
it was
extension
a
of the non-steering into cards.
yeah, it was a letter of guidance, and they said
Hmm.
it was under, I think they said their deceptive standard. I don't think it was
Deceptive.
under
Okay.
impair. I think it was deceptive,
So
right?
we're
Because
still talking about UDAP here in
yeah,
general.
that's
This is
UDEP.
what this is modifying. Okay.
Yeah,
All right.
and saying that it was because the customer didn't know that, let's call it the lead gen, that the lead generator had a thumb on the scale here,
Mm-hmm.
then the consumer's best interests weren't in mind, and the consumer assumed when a lead generator says, "Come find the best credit card for you," that it's actually the best credit card for you, and not a good credit card for you that works out really well for the lead generator.
Let's take a quick break in the action here, because I'd like to introduce you to our newest sponsor, Fintel Connect. They're an affiliate marketing platform that can help connect you to publishers, influencers, and manage your compliance. You may have heard of platforms like CJ, Rakuten, and Impact, but none of those platforms serve financial services companies exclusively. That's where Fintel Connect shines. Folks that have used their platform tend to talk about their compliance platform and their ability to connect with social media and influencer publishers that you may not find elsewhere. Additionally, because they're FI only, they have a deep empathy for the challenges that lenders and banks have when they run their affiliate marketing programs. I'd love for you to check them out. You can find them at fintelconnect.com, FINTEL connect.com, where you can connect directly with their founder and CRO. So if I were to replay the purpose of non-steering, let's talk mortgages for a second, then
Sure.
we'll talk
Mhm.
cards. So
Yep.
mortgages, the reason the CFPB, the regulators are concerned about this is they're worried that there would be a number of business incentives out there for providers, whether it be lead generators or mortgage providers, that results in an outcome of the consumer not being promoted the best product for them. Is that kind of the gist of it?
Yeah.
Okay.
It can lead to stupid results, right?
What are some of those stupid results it could
Yeah.
lead to?
So, like, if you've ever bought a house, right? At one point, you've probably asked your real estate agent, "Hey, who's a good mortgage person?" And they're going to say, "It's Carlos, right? He's great." But I can't tell you to use Carlos. So Carlos is the best, but here's two other good ones.
Okay.
And it can lead to absurd situations of like, hey, hey, I need a pest control company. And well, here's three good ones, and I don't have an opinion on which one's the best one because I can't because of RESPA, right? And it's just one of these things like it just spirals down to this just absolutely nonsense of you have trust like of someone who's supposed to be your trusted advisor, your realtor or your loan officer, and like their hands are tied by like stupid compliance rules, right? And
So
I
they,
say that
they cannot have an opinion around the provider, even if they're not getting paid at all as a result of the
in some situations
recommendation.
that's right, and you'll see it with affiliated business is the big one, right? I mean, in mortgage and real estate companies have their own mortgage companies, they have their own title companies, they have their own home warranty companies, and because of that, those are all different streams of income, but they're affiliated business, and RESPA also has some language about affiliated business, and nobody wants to be seen steering to the affiliated business, even though it's a good client or it's a good customer product for the customer or
Mm-hmm.
whatever. So it just leads to some really odd situations. But that's the nature of that business. But you're exactly right. It leads to situations where it's trying to prevent, excuse me, situations where the customer is not being given the best option for them because of incentives to the other party, right?
Got it. Does that mean if I'm a lead generator for mortgages, when I sell leads, I have to sell them at the same price to everyone in my ecosystem, everyone in my marketplace, or can I sell leads at different prices to different providers?
That is a great question. That's a great question. I would say, generally speaking, there has to be something differentiating it. Okay. Phrase that I used to use all the time was similarly situated lenders should be paying similarly situated prices, right? So, an example that I used to give why we would base it pricing differently at a prior employer, right, is that we always use the example of leads in South Dakota. Okay. If you are only want leads in South Dakota, okay, you're going to pay a certain price because that's a limited pool, right? And so if you're a bank and you only operate in South Dakota, you care more about those leads, right? So they're worth more to you. Now, if you're a bank that only operates in the upper Midwest, right? You've got North Dakota, you get South Dakota, you have all those other states, right? That so you want South Dakota leads, but they're just a mix of what you pay, right?
Mm-hmm.
And so you're willing to pay something different. If you're Wells Fargo, South Dakota is one of 50 states for you. That payment looks different for you, right? So it's still valuable, but it's different. Um, you're not going to shut down your bank if you can't get South Dakota leads, right?
Got it.
So because of that, we look at how are lenders similarly situated, right? And geo is one, right? Credit band is another way. Uh, Loan product is another way. Whether it's a purchase, whether it's a refi, whether it's a home equity product, those are all different ways. And then there's some other ways you can slice and dice that too. So, but you put all those in buckets, right? And the lenders that want to buy this bucket product with this geo and this loan amount and this credit score, that price looks like X, right? And this customer over here looks like this, this, and this. So its product is Y. And that is how you end up with different products and different pricing. How you should end up with different products and pricing because you want to be able to tell CFPB or regulator, hey, actually, if you're buying these leads, you're paying this price, right? Um, where people get into trouble or have gotten in trouble in the past is tiering out pricing, right? Or promising certain volume. And that can get problematic very quickly, right? Because you're either going to expand those buckets, right? And to get them those leads, and now you're not treating similarly situated lenders the same. And I mean, I would bluntly have conversations internally and say, hey, if lender B came and said the same thing, would you do this? And if the answer is yes, then yeah, let's do that, right? If they's like, no, we really only want lender A to do this. Okay, well, then we're going to need to think of a different way to do that because that's going to run into some steering issues, right?
Got it. Got it. You mentioned earlier there was a prompt, or I forgot the word used to describe it, but there was an action taken by the CFPB last year,
Mm-hmm.
2024, to expand the non-steering rules. And actually, let me give some context just from what I've
Sure.
seen. I started at Capital One in 2006,
Yep.
and I joined Credit Karma in 2016, and now I kind of all I do is affiliate marketing with lenders, cards and loans primarily. I've stayed out of mortgage for
Yeah.
actually more to do with RESPA than you would like to think.
Yeah.
There's some reasons that my business gets challenging
Yeah.
just with the RESPA considerations. But I've always seen publishers take CPA at least into consideration. It's not typically the only thing that they use to determine what offers they show. They'll consider the response rate. They'll consider the value of the consumer. They'll consider the application rate, the approval rate. There's a number of factors. But at the end of the day, many publishers are factoring in the monetization of a specific offer. Monetization isn't just the payout. There's the funnel dynamic as well. But that's very common, and I've rarely seen, or I wouldn't expect that to change. However, you said there was that action in 2024. What motivated that from the CFPB, and like why was it pulled back?
Bluntly, I think the motivation for it was that it was a different administration. And I think it was that CFPB was very active. It was perceived to be very consumer focused and trying to avoid consumer harm. And the CFPB, I would assume, thought, hey, if this is causing consumer harm in mortgage, it's probably causing consumer harm elsewhere, right? And that was a lot of it, right? I mean, it's just bluntly that.
Mm-hmm.
So, and why did it get rolled back? I think because administration changed. I think if the administration didn't change, we wouldn't I don't think that would have gotten rolled back. And I think that would have still been. I think the CFP would have got more aggressive. To be honest with you, I said last year, at the beginning of the year, I posted on LinkedIn. I've said, here's my 4 predictions for the year, and one of them was I think a large lead generator is going to get nailed by the CFPB, and it was because of the mortgage and the card thing. Now I don't think that now, because I think the CFPB is going to be gone.
So was the order formally rolled back, or are we assuming it was rolled back?
It was
because the CFPB.
So the CFPB, like you said, within the last 3 months, 2-3 months, said, here's all the informal guidance that we've given over the last X number of years. These aren't good law anymore. These are not. We are revoking all these, right? And that was one of them. So now, does that mean it's the Wild West in cards? No, it doesn't. And the reason being for that is nature abhors a vacuum. And you are seeing in certain states, right, that those states will come in where they think a federal regulator should be, and those states will come in and be very active in that space. If I was a credit card lead generator, I would say, hey, CPA can be a factor, but it can't be the sole factor, right? Like, all things being equal, we probably shouldn't just rely on CPA, right? So only because I don't want to, you don't want to get into a situation where California or Massachusetts or New York comes in and says, you guys are hurting consumers by you're only sorting by price, right? So that's just a thing to always keep in the back of your mind.
Cool. So let's pivot now to the state of the industry overall. Yeah. So we have some extended color now on the CFPB, what they're doing, RESPA. So I think I got more than I bargained for on that one. But that was
Carlos,
super educational.
I told you at the beginning that I can talk for a long time on a lot of topics. So you just got to spin me up money.
This is good because I'm certainly not the compliance expert or anywhere close to it, but this stuff touches the work I do with lenders all the time. And I usually just lean on our clients' internal counsel or compliance teams to make the judgment calls, but it's always good to have an opinion on where the industry is and what folks like yourself have to say about it. So you had mentioned 3 things on the state of the industry that were worth hitting on. Let's start with the first, which was you said as fintech, and I assume here you mean fintech consumer brands, neobanks, that sort of thing.
Yeah.
They need customers. They're going to move further into lead gen. And there are problems when you only care about the number of leads you sell versus the quality of the leads. Can you expand a little on what you mean there?
Yeah, I think what we see a lot is, I'll paint with a broad brush because it's easier. PE-backed company, they've got aggressive customer acquisition targets. And then market realities come into play, and they realize that maybe they're not the only people in the world bidding on best credit cards, right? So what what we see, and I've seen it over and over and over again, both in-house and in private practice, companies say, "Hey, I really got to scale marketing. My team's doing a great job, but I'm going to have to lean into an affiliate space or a pure lead generator space, right?" And okay, great. Then there's ways to do that. And what happens is you see people go to, I'll say, lower quality lead generators, right? I'll be polite and say lower quality lead generators. And they don't necessarily understand how it works. So they're just saying, the lead generator says, I'm going to give you 10,000 leads a month. And they're like, God, that's great. Okay. And they don't ask any more questions. And what happens is they don't say, where are you getting those 10,000 leads from? What are you doing to get those 10,000 leads? And that is when the problems start. So what happens is these could be leads that this lead generator has bought. It could be aged leads. They could be leads that the lead generator is driving, right? And that's great. Like there's good and bad of all those situations. And for the right customer, those can all work, right? But what happens is when you don't understand the process and you don't ask about it, it causes problems, right? Like now you're buying clients that don't want to hear from you, that don't even know who you are, that don't even know what products you're offering. And if you're calling them or texting them, you're running into TCPA issues. You have you're buying problems. That's what I say, right? Like if you don't
Mm,
understand how they're generating the leads, you're buying problems. Um, and so that's when people get into bad situations. And I've seen it 100 times, like, oh, we'll never do lead gen because we tried it once, right? And so, our executive team doesn't want to take that risk again. Well,
got
it's
it.
because your executive team didn't know what they were, didn't know what they were buying because your marketing team didn't know what they were buying. And so now we've just painted all those with a broad brush and lead generators are bad, right?
Got it.
When that's not the case, as you and I both know, there's people that are doing it right. There's people that are doing it as as cleanly as possible, but those prices can look different,
Got
right?
it. I mean,
So
it sounds like you're distinguishing, or at least one point you're making here is good lead gen sounds like I know where the lead came from. I generated it myself. I can paint a clear picture from the consumer perspective of how they saw the ad, how they got to my landing page. It's very linear and clean and well described versus bad lead gen is, oh, so and so Johnny from North Dakota sold me 10,000 names and emails and phone numbers. And I never bothered asking Johnny where they came from or how he sourced them. But now I'm putting them in my CRM and I'm hitting this
yep.
list. How is that like if that were to run into problems, like there was a lawsuit somewhere, someone on that list said, "Hey, you weren't authorized to call me, what have you." How is that liability distributed amongst the lender and the publisher? Is that a shared responsibility, or does one side get more of the brunt of it than the other?
So that's a great question. And so I'm going to take a quick step back. So the law that you're concerned with when calling or texting customers is the Telephone Consumer Protection Act, TCPA. TCPA uh, prevents the seller, okay, and I put that in air quotes because that's the defined term in the regulation. But in our scenario, it's actually the lead buyer. They're selling the actual services, right? A loan, a credit card, windows or doors, or whatever it is, right? They're the seller of the services and they're calling the consumer. Okay. So it prevents them from doing that without the right level of consent, depending on the type of call. In our scenario here, right? Our lender is the seller. They're calling based off the leads given by the lead generator. The seller will get sued because the seller doesn't have the right consents. The lead generator, how they get brought into it is through indemnification language, right? So the lender is going to go back to the lead gen guy and say, hey, I bought these leads from you. I'm getting sued by them. You owe me money. A couple of things can happen then, right? One is, okay, great. We have a plan for this. This is how we'll do this, and we'll help you defend this, right? Another is radio silence. And I've seen that a lot as well too, right?
Johnny disappears.
Yeah. He now lives in Bolivia and no one can find him, right? It happens all the time. It happens all the time. And that's why I like to say a portion of the TCPA is very technical, right? Like get the consent language right. Make sure you're doing this right. Make sure you're doing X, Y, and Z right. But another large portion of it is third-party vendor management, right? Know who you're dealing with, know how they're driving traffic, know what you're buying, right? And if you can do those things, you can minimize some of your TCPA risk, right? But that's how the lenders and the lead generators get brought into this. Because of the chain we just showed, lender gets sued, they come after lead generator. You can see why the more links in that chain from the actual consumer, the more risk you run. Because if you're buying leads from someone who's buying leads, from someone who's buying leads, you better be hoping all those people are doing it right. That's the real risk, is when there's multiple links in that chain.
Because only one of those links needs to fail for the lender in this context, the seller of goods, the lender could get wrapped up in
Absolutely.
a regulatory problem. Got it.
Absolutely.
I want to pause here for a second to tell you about one of our sponsors, Spinwheel. They've built an API that streamlines your lending application form with just 2 fields. When a customer shares just their birth date and phone number, they can go grab all the information needed to pre-fill their application form. So regardless of what channel you play in, you know that the higher the application rate goes, the lower your cost of acquisition becomes, and the more media you can buy to generate growth. Additionally, they can give you real-time verified consumer credit data and seamless payment processing, which can help you serve customers beyond the initial application. To see a demo, go to spinwheel.io or check out the link in the show notes. It'll hook you up straight with their head of growth.
That's interesting context. Cool. All right. So there it sounds like the worry is because the fintechs, this is a broad statement. I don't know that it's necessarily true. But I do observe the difference between big banks and fintechs, at least in the amount of time that they spend reviewing things for legal and compliance risk.
Yeah.
I'm not saying the big banks are more diligent per se, but they at least appear to be more diligent because they have bigger teams and they have more staff and they take their time with external party reviews, that sort of thing. Versus I've seen fintechs say, oh, this deal sounds good. There is a review, but it's faster. It's a little bit quicker. And I'm going to make the assumption more risk is assumed on the fintech side than on the big bank side. And that's what I think you're worried about here as far as like state of the industry is a bunch of folks coming in buying leads that don't fully understand how they're generated.
Yeah.
Okay.
Yeah.
All right. So let's move to your second one. Unless you have anything to add here, John.
No, I was just going to say that before I got into lead gen, I worked at a bank. And I like to say, Carlos, that nobody ever got fired at a bank for saying no. So
that's definitely a maxim of consumer lending.
Exactly.
That applies to any part of the business.
Absolutely. So that's why those internal bank reviews take longer.
Yeah, no, 100%. It's actually one of the reasons why the fintechs have gained market share is because they're more willing to act and take risk, and not all those risks are going to bear favorably for the fintechs, but many of them are. Okay, so the second thing you shared as far as state of the industry, you said fintechs and state privacy laws, and to a lesser extent, state licensing laws. So it sounds like you're expecting some state activity here. Or like, what can you say more around what you think is coming?
Yeah, I think that if you've been in this digital marketing industry for any time over the last 3 years, you've seen an increase of state level privacy rules and regulations.
So like the
Uh,
CCPA, for example.
yep, exactly.
Okay.
California is the bell cow for this, right? Colorado has a big issue there. Texas has a big issue. So you've got multiple states with rules, all of which are different. And then additionally, I think the next thing you're seeing on top of that is rules around data brokers. And what I've seen over the last, let's call it year, is the data broker rules encompass a lot more than people think they encompass. And companies that 3 years ago wouldn't have thought that anyone would have ever called them a data broker now are realizing, oh, I probably am a data broker, right? And therefore, you run into issues with California and Colorado and Texas and these other states. So, one area, and I'm sure you've seen it too, is fintech companies are built to go do X, right? And they're going to focus on X. And then they realize that they have all this data that they've gathered from certain places. And gosh, wouldn't it be interesting to uh, see if we can get a little side hustle with our own data and generate some business? And once they do that, right, you can run into a foul of the data broker rules. So that is an area that I think fintech companies need to be concerned with. I also think they need to be concerned with that. Um, Again, third party vendor management. What are your partners doing with the data, right? Um, are you buying leads from a lead generator that is also a data broker? And what does that mean for your business, right? How does lead generators brokering of their data affect the data that they're giving to you and your customers, right? Because you could foresee a world in which I go to Credit Karma, I give Credit Karma my information, they sell it to company X, right? I'm now company X customer, and then I get a letter in the mail that Credit Karma has sold my data to company X, or company Y, right? And I go back to and because my only connection there is the company I enjoy doing business with, right? I don't understand how that's separated from the Credit Karma data broker situation, right? So that's just third party vendor management. So it's just something that you've got to be cognizant of.
Let's say I'm a fintech lender. What are the one or two things I need to avoid here to get to kind of make sure my slate is clean as it relates to the state privacy laws?
Yeah, I think that's a great question. I think it's let's call it intake and storage, right? Or
Okay.
intake and usage. What data am I getting from outside? Okay, that's thing one. Where am I getting it from? What is it? How am I using it? Thing two is internal usage. How are we using it? How does it leave us, if at all, right? Um, and if it is leaving us, what are they doing with it? Because I think those are the kind of things, like obviously very high level, right? Like if you're going to draw a data map is everyone's favorite thing in the world to draw, right? But if you know where what your data is going, as soon as that customer first hears about you, whether it's from your own marketing or third party marketing, you should be able to track that data all the way through its life cycle through you and make sure you're not running afoul of any rules there because there's certain guideposts along that way, right? Of if this then that, this could run afoul of California. If this then that, this could run afoul of Colorado, right? So that's the kind of stuff you've really got to understand. And I think I think people are getting a lot better about it, but I think an area of risk is that old mindset of I don't have anything to do with this data now, but I might in the future, right? So we'll just keep it. Okay, well, one, that in and of itself is running afoul of some state laws, which is they have data minimization requirements, right? But the other thing I think it is I think you and I've talked about this before, of just like that snapshot in time when that consumer came into your ecosystem 2 years ago, not really worth anything now, right? A lot happens in 2 years. And so like if you're going to keep it for 2, 3 years, because one day you may want to go back and, segment this customer out, like how do you even know that customer is still in your segment, right? If you have no additional data points from them from the time you acquired them, you might as well assume you know nothing about them, right? And I have friends that are in the data space in this industry, and they're like, John, you're so wrong about that because we can go append data and we can go figure this and that. Well, okay, great. But once you've appended data, now you've triggered data broker rules, right? So like you've got there's so many issues there that like that's why I really, for lack of a better term, and again, my data scientist friends will hate that I use this term. Uh, like your data hygiene is important. Like, what are you doing with it? How are you making sure it's right? And like, how long are you keeping it? Is those are the kind of questions you want to ask.
Got it. So is the picture getting? I want to make sure I understand the implication for the lender, because when I hear state by state regulation, I can go one of two ways. One way I go is lenders start solving for the most conservative case. Could be California, state like that. Or it could be lenders actually try to go state by state and have different processes and systems state by state, because it may open up more business opportunities for them that way. Which of those two models do you normally see, or is there some third model that lenders normally adopt?
Well, the good news is for most lenders, right? If you're going to abide by GLBA principles, Graham-Leach-Bliley principles, you're fine, right? So like that has created that baseline there, right? And so we see from a lender perspective, that's what I see the most. Is they're like for GLBA, we're going to go do that, and that's fine.
So we're going to keep a really high bar, and that way we don't have to worry about all these other state
because a lot of states also will exempt you if you're subject to GLBA, so that right. From a lead generator perspective, I've seen both of those scenarios. One is that they try to do a geo target and they understand this is not a California customer, this is a Mississippi customer, and so we're going to treat them differently, right? That's problematic. Like that's you can guess there's problems around that model as well. I would say let's call that 40%, right? That other 60 is say we'll just follow California and figure it out later. Yeah, because it's the broadest and it's also the one, for better or for worse, that's the most active. So like they have this amorphous image and they're kind of doing some clarifying of what it actually looks like. For better.
That makes sense. The third kind of state of the industry comment you had was pertaining to AI, and I'll just kind of add here something I've heard just through friends in the industry, and I can't confirm whether or not this is 100% factual, so take it as rumor mill for now, John. But this is what I've heard. I've heard that very, very large Fortune 500 brands, household name banks, some of them have issued mandates at the top of the house of the company that anyone that generates leads for their business cannot use generative AI as part of their process. That surprised me, just given the state of where we are in tech. And if you're on, I know you're on LinkedIn. I'm reading this stuff all the time. I can't stop my feed, without every other post being about generative AI.
Yeah, right.
So the fact that banks are saying no, it's actually mandated, or at least it's rumored that banks are saying it's mandated that my lead generators cannot use generative AI was a bit of an eye opener for me. So, one, do you believe that rumor? Do you think that's true? And two, if so, like where do you think that's coming from? What's the concern here?
Um, One, I wouldn't be surprised if a flavor of that was true. Um, Again, going back to the comment, nobody gets fired for saying no, right? Those banks, one, they're the biggest lead buyers, so it's problematic. Two, they don't know how they're using it internally a lot of times, and therefore they think, oh, I have no idea what's going on in house. I sure as hell don't know what's going on out here with it, right? AI. And I think that's probably a lot of the impetus for a pushback from those bigger brands. Um, I've heard similar things about large insurance carriers, so I'm not super surprised by it. Now, why would they think that? Well, part of it is going back to the conversation we just had about state privacy laws. You're seeing a lot of state laws come in around the use of generative artificial intelligence in decision making. And certain states are defining it certain ways and carving out certain exemptions. Like Colorado has one, um, and it's actually live. It goes live next year, but it's like on the books. If you're using artificial intelligence to make high risk decisions with high risk artificial intelligence to make consequential decisions, which is financial, insurance, health, uh, and there are a couple other things, but essentially lead generation companies, right? On every lead generation vertical, um, you have to like file like certain disclosures and all this stuff. Now, Colorado does also have an exemption for marketing, right? If you're just using a high risk artificial intelligence to make some marketing decisions, uh, arguably you don't fall under the Colorado statute. California has a similar statute that does not have that carve out, right? So I think that kind of regulatory pressure from the states and lack of any guidance from the federal government, which is also true in the privacy sector, right, um, is causing a lot of consternation for lead buyers, right? Like I don't know, goes back to what we just said of like, if I don't know how I'm using it in house, I know there's a lot of regulatory risk around it. I don't know that I'm going to go trust, you know, the proverbial kid in his mom's basement that every single person seems to use as an example in lead
Johnny
generation.
from North Dakota. That's
Yeah,
what I call him.
yeah. Except I don't know any of those people. So, but yeah, like those, I think that's probably where that's coming from.
Got it. Okay. We kicked off. We dove straight into the deep end on the CFPB. What was going on? Whenever we didn't properly introduce you, John, can you walk us through your just quick background on what you do today and kind of your journey as a professional?
Yeah. So I live in Birmingham, like I said. I lived in Birmingham. I went to law school here. I lived here for 10 years, worked at real estate company, and then I worked at Regions Bank, which is a large regional bank in the Southeast. It's a top 25 bank in the country. Uh, Left here, moved to Charlotte to go work at LendingTree, which is how I got involved in lead generation. So lead at LendingTree was interesting. I ran the compliance function for 6 years. I was interim general counsel for 6 months, and then I left the legal team and worked in the business and was a GM of mortgage for about a year and a half. And that I did mortgage, purchase mortgage, real estate leads, and then I launched a product for LOs, right? So, which was a really interesting experience and has really helped since then working with customers, clients on the legal side to help understand some of their processes, understand what they're trying to deal with because, yeah, no, I've spent weeks trying to make one Salesforce field appear as well. You know, so I understand how annoying it is. After that, I left LendingTree and I was general counsel of a company called ConsumerAffairs.com, based out of Tulsa, but it was remote. So I moved back to Birmingham and then left there and went to join a law firm, Troutman and Mean, for about a year and a half. And then recently left there and started my own law firm to where I help clients in the marketing compliance space and legal issues there. It's been great. I've met some great people, had to have some had good conversations, and really excited to grow this next chapter of my career. I, I say that it's a law firm, and it is, but like it's got a lot of consulting feel to it, which I like, right? And which I can leverage some of that experience working in the business and not just on the legal side to say, hey, have you thought about this? Have you thought about that? So, come for the legal, stay for the product.
That's awesome.
That's 100% a joke, by the way.
Yeah, no, I love it. I love it. I love it. I didn't appreciate that detail until you said it, that you popped out of the legal organization or the legal function and were kind of operated as a GM for a little bit. What prompted you to? Sounds like you've had a great career. What motivated you to take the risky decision, or many would perceive as a risky decision, to start your own practice?
Yeah, no, that's a good question. So like I have a good relationship with the firm I left. Still, it was just one of these things of like, there were things that I wanted to focus on that wasn't necessarily the same focus of the firm, right? That firm is a very TCPA heavy firm, and probably 80% of my practice was TCPA, which is great, and I got to be an expert in it and a lot of knowledge. But you're answering the same question 5 times. 5 times you have 5 calls in a row and you answer the exact same question, and it would get to the point that I would say on the call, my paralegal, I was like, my paralegal's tired of hearing me say this, but da 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 da, right?
Yeah.
And so that's been part of it. And then bringing some of those clients over some of the clients I brought over were clients that needed just a further compliance, not just TCPA compliance, because they're growing for whatever reason and they need marketing assistance and kind of break into other channels, not just text calls, right? So I've been wanted to kind of expand it that way.
So just for my listeners here, if you're not interested in social media, personal branding, building businesses as an entrepreneur, this may be your moment to hop, because I think that the conversation here is about to take a sharp turn, mostly just because I'm personally curious, John. I had this kind of a similar path, was in the corporate world for a long time. Obviously not in law, more marketing analytics. That's kind of my DNA. And then my motivation to hop out was actually a little different than yours. I actually wasn't solving the same problem over and over like you described. My issue was I didn't feel like I was applying the stuff I knew best to the highest leverage every single time. I found myself in just a lot of administrative stuff, like writing performance reviews and having one-on-ones with folks and writing board updates and decks out to the leadership team and all hands meetings, just a bunch of stuff that had nothing to do with what I signed up for, which was generate business through affiliate partnerships. That's kind of what I do best. And honestly, where my value to the organization is highest. So I got frustrated over the years that the time spent in what I perceived to be high value just kept shifting in the wrong direction. It was like the admin kept growing, probably as I got more senior in the organization, and kind of the core work kept decreasing. So that was part of my motivation. Part two was just wanting to control my time a little bit more. So having a calendar full of meetings that someone else set for me just wasn't, especially after I had kids and things like that just became less and less appealing. So it was a combination of those two things for me.
Yep.
So I guess where I'm going with the background here is the pivot for me and what really got me comfortable starting my own thing was being able to attract business through LinkedIn and social content. And since I've since started a newsletter and this podcast, so I've kind of gotten more all in, quote unquote, on content.
Yep.
But it's really how I meet people, and ultimately what drives attention to the company and builds trust with potential buyers. I see you're very active on LinkedIn, so walk me through like your story there. Like, how did you figure that out? I assume LinkedIn is part of your strategy here for acquiring customers. So walk me through how you use LinkedIn and just how you acquire customers in general.
Yeah, yeah, absolutely. Yeah, so a lot of people don't know, but lawyers have rules on how they can get clients, right?
I'm
And
more familiar than most because I built a business in this
yeah,
category in 2021. So, but yeah, walk us through
yeah.
the constraints there.
So the reason you see lawyer billboards, lawyer TV ads, lawyer radio ads, all that stuff is uh, lawyers can't outbound, right? Like I can't call you and say, Carlos, I know you have a new business. Would you like legal help with it? Right? Like I can't do that. Like I'm constrained by my state bar rules. So you have to bring traffic in, right? And the people I want to work with, a lot of them are on LinkedIn. It was easy for me. It's the only social media, quote, social media that I'm on, because I don't care about anything else. Um, for on the social
Plus
media
one. I'm
spectrum.
not on any of the other ones.
Yeah,
Same with me.
yeah. Like my kids will send me TikToks, and I'm like, you'll have to show me on your phone because I don't have TikTok and I don't care. So, uh, um, but yeah, so I did that. I started it as an outlet when I was at Consumer Affairs, um, because I just had opinions. And, I kind of found a little niche. I have a very small following comparatively, but I would say I probably have a very high percentage of my clients in that, or potential clients in that following, right? And that's the key for me. I don't want to be somebody with 100,000 followers, if 0.5% of those people are potential clients. I'd rather have 5,050, right? So uh, that's kind of how it started. Yeah, and by the way, I resonated with your story because the reason I left in-house is because the further you go up the food chain, the further away you get from the stuff you like doing, right? And I was like, I don't want to argue with you about your cap table anymore. So, I'm out. So that's, but that's how I use LinkedIn. That's kind of how I think of it. I think of it as it's both um, it's a BD tool, but it's also a uh, way I can like talk on things I care about, right? In a way that is fun for me and lets me get my thoughts out, right?
This is a quick plug here for my marketing agency. It's called New Market Growth. We do nothing but help fintech lenders accelerate their growth in affiliate marketing channels. Our services are both strategic and operational. And if you want to learn more about how we can help you, find us at newmarketgrowth.com or email me directly at carlos@newmarketgrowth.com.
You mentioned you started in while you were at Consumer Affairs.
Yeah.
Like, can you put a timestamp on that? When did you send out your first post?
Uh, Probably my first regular time posting was, what year is it now? Um, Probably early 2023, so probably 2 years.
2 years. Okay.
Yeah.
And was part of your decision to go solo connected in any way to the fact that you had found a way to get attention on LinkedIn, or were they completely independent
No,
decisions?
I think that um, I had proven to myself that I could do it, right? And I mean, like my law firm knows this. When I left Consumer Affairs, I was thinking about going in-house. I mean, going solo to begin with, right? And ended up going to the law firm and then left. So like nobody, I don't think anyone was super surprised I did it internally. Uh, so, but at that point, I had figured out, and I had clients reaching out, potential clients reaching out on LinkedIn and wanting to talk about things. So I was like, oh, okay, I could probably make this work.
Got it. Okay,
You know,
so you had already seen some inbound on the
yeah,
back of
yeah,
your
yeah,
content. Okay.
yeah,
Yeah. It was the same thing with me.
yeah,
I initially started writing purely for professional brand reasons. I wanted lenders that wanted a head of partnerships
yeah,
to think of me on their short list of potential folks to hire. And that was my goal. That was it. And then I started do the same kind of inbound. Hey, I have questions. Can we chat? And then I started seeing enough of that where I'm like, hey, this is a sales pipeline.
yeah,
This isn't just people wanting to meet for fun. These
yeah,
are people with problems that I could potentially help them solve.
yeah,
And that was a big reason why I said it gave me the conviction to say, yeah, I can cut the cord here and just build the business. And then I turned on the gas
yeah,
on content. I started posting 5 times a week, added the newsletter, added the podcast. It ends up being a real investment from a time perspective. The nice thing about it is I don't spend a penny on media. I
yeah.
never do paid stuff. It's all organic. How much, like, what's your content process? Like, is there like a single day that you just pump out all your posts? Do you write a little bit every day? Like, what's the method behind the madness?
Yeah. So it's funny. I think this happened on a call that you and I had not too long ago. Like I said something that I liked how it came out of my mouth, and I was like, hang on one second, and I wrote it down. That sometimes that happens, right? And then I like try to build something off of that. And then uh gosh, I would love to sit down on Monday mornings and spend an hour and write all my posts for the week, but I generally write every post every day. Like as soon as I sit down. The one exception is I have started doing on Saturday mornings 5 things I've learned this week, which has
Okay.
been
Yeah, I
really,
saw it this weekend. I thought that was cool.
yeah, it's been really good. I've really liked it. I got a ton of engagement on the last one. Um, so that one I do like make a specific effort to say, oh, that's something I should talk about like that, right? Because it's maybe just short enough that it's not its own post, but I'm also to some extent, the extent possible. Um, I can't believe I'm going to say this, and I hate the fact that I'm going to say this, Carlos. Like there is an aspect of building in public that I want to be very transparent about, right? And I think it does help people, or at least gets people to understand. I think there's two things it does. One, it helps people see not everything's great, right? Like
Yep.
I'm not going to be the person that's like, oh my God, all I'm doing is winning. What do I do with all this winning, right?
Mm-hmm.
That's just not me. The second thing is that it does is um, I think it helps people realize that you're a real person, right? And just like I have kids, like I talked about like I spent my weekend at a lacrosse tournament this weekend. And like it's uh yeah, like my kids are the reason I do all my things. And so from that perspective, I'm not going to necessarily shy away from that. But I'm also not going to necessarily I'm not going to apologize for it either. So
Right. Yeah. No, the build in public thing is, I find it hard, to be
yeah,
honest with you.
yeah,
It's something I played with, and I have a couple challenges on build in public, and I do think I have some level of transparency on like what I'm doing, what I'm focused. I think people generally
yeah,
know what I'm up to. Um, the challenge I have with it is if I were to be all the way vulnerable, all the way transparent, I think it could start to expose certain like confidential things about like client relationships that I have. And I'm sure you have the same thing. So like that's the one thing that holds me back with like really leaning into the transparency. But I do share like personal failures. Like I think I did a whole 2 week series a couple years ago on it was a legal marketplace. So you'll
yeah.
appreciate this business and how gnarly it got for me. I was connecting lawyers to consumers.
Hmm.
That was the business model, and we had a number of challenges. But I ended up shutting that business down. And I just wrote for 2 weeks. Every day was a post on like something new that I learned from that experience. And my engagement level over those 2 weeks just went through the roof, man. Like, just an incredible amount of inbound. A lot of people, actually former founders of similar businesses, I got to meet. I think it really did humanize me, like you said. So like I love that. I love pushing on like the vulnerability and like the lessons learned. But as the build in public is the thing where I'm like, I don't think I can be built in public, because I just don't think like the idea of my business plays well with that. If it was a consumer business, I think I would be a lot more comfortable. But because there's client relationships involved, I get a little scared.
Yeah, and I obviously I have ethical things that I can't talk about clients and all that. I generally don't even tell people who my clients are unless they ask, and in a confidential way. But it's weird because there is that level of humanizing to it, right? Of like, I wrote like last week that why is every single service paid for by the month? Can I not just write you one check and just get the damn service? And like the amount of messages I got, both comments and DMs about that, is like fascinating. Like, because I think I think people have pain points and things that drive them crazy, and they love to see when other people. Like, I think it's Schadenfreude, right? They love.
No, it's validating.
Yeah,
it's validating.
Like,
it's like, oh my god, I'm not crazy.
Yeah.
It's funny you mentioned that. I had I'm not gonna name the publisher because it's been a whole thing, and I even apologized to the publisher later. But I was trying to do a deal with a Pacific publisher, a well-known brand, and it was just like impossible for me to get someone on the phone or respond to it was just crazy. So I thought nicely. I was like, hey, I'm trying to get in touch with somebody here. Can someone please help? And the thread just kind of went nuts. Okay. It took on a life of its own. It had like 120 comments. And it turns out a lot of people shared my frustration with that publisher.
Yeah.
And that just kind of struck a chord for whatever reason. And, apparently it caused problems for that publisher because people senior over there saw it. And, there was some backlash that came of it. But my intention was to just get a deal done.
Yeah.
But it turned into a whole other thing, right? It turned into like people creating an exhaust valve for people's emotions on this thing that no one else felt like they could talk about in like a public setting.
Yeah.
So no, you're right. Like when you're just transparent and kind of real about stuff, like you just it's hard to know who you're going to connect it with. So I've seen it happen too. How do you balance like that more personal content that humanizes you with content that educates your ICP and kind of makes them consider you as a potential partner?
Yeah, so I'm going to say this, and it's going to sound like, God, John has like a master plan. But like, I am very much aware of those humanizing posts will drive engagement. It will drive potential followers. It'll drive eyes. I take those eyes that I've driven, and then like, do you like compliance conversations? Because if so, you'll love this, right? And it's to me, those humanizing ones are at the top of the funnel, right? And then so I don't do a whole lot of call to actions from like, I don't ask a lot. I try to give a lot. I'm a big believer in giving a lot. Now though that I am like trying to pay bills, I am like, I probably will ask a little bit more, but that's kind of how I view it. It's like those, but I don't want to just be the guy that does like, here's funny things my kids say or whatever, right? Like, because I don't think that's not helpful, and it'll turn off my ICP, right?
Yeah. Gotcha. Yeah, no, we have I think similar views on it. Based on what I've seen in like the last 30 days from you, you do way more humanizing stuff than I do lately. I started on LinkedIn for about a year and a half. It was all just about my lessons learned, stuff I like, stuff I do. I play a lot of poker. I wrote a lot about that. Like that, I met a ton of people that shared that interest. And then I think, for better or worse, and like I don't know how to fully think about it. I really started becoming kind of an affiliate marketing robot for
Yeah.
like a year. Like my newsletter, my podcast, everything. It's like 90% affiliate marketing.
Yeah.
And it does work from a lead generation perspective. It drives business for sure to my agency.
Yeah.
What I've seen missing lately, like last year or so, is I haven't met as many interesting people through LinkedIn versus when I was just like more on the humanizing stuff.
Yeah.
I met all sorts of cool people that we just had a good vibe with because I had kind of more of a magnet for the stuff I care about and what I do. So I do think I'm probably off balance on my mix. I want to steer a little bit more towards, maybe it ends up 70-30 for me. 70% educating on what I do, 30% like what I'm up to, what I care about, that sort of stuff. Yeah. Pictures with the kids at the park. Like I did one of those recently. That one had great engagement. So like I need to do a little bit more of that.
And we may cut this later, but I'll tell you why I've leaned into humanizing lately is because the firm I left has such a strong identity of a certain thing that I'm not.
Mm,
And so I'm trying to differentiate myself from
sure.
them
Yeah.
to some extent, right?
Yeah, because
And
people will see your profile and assume certain thing about who you are based
exactly,
on logos, right?
exactly,
Yeah.
right. So I'm very cognizant of that. And so like I am trying to like say, hey, this is actually John, and this is not, and that's if you thought I was this because I was over here, I'm actually not that way, right?
Yeah.
So,
No, it's interesting.
um,
It's interesting
yeah,
you say that.
yeah,
There's one thing I do in my content that's very intentional that has worked, and I don't know if it's because of this or if it's, maybe it's accidental, but I'm very like colloquial, casual in my language.
hmm
Like I'll drop an F-bomb in a podcast here and there. I'm pretty even, like I do not want to come across like I'm a C-level at Wells Fargo.
yeah,
That's not me. That's not my vibe. That's not what I'm all about. I don't want to attract people that have that expectation of me.
right,
I want to attract the fintechs that want to get shit done, want to move quickly, and that want someone with the right background and the know-how
yeah,
to work with them. But I'm not interested in writing long documents or having formal meetings or having board readouts. That's not my vibe. It's why I left the 9 to 5.
yeah,
So my content, my message is very serious, but the way I say it and deliver it is relaxed and it's casual because I want that vibe drawn to me. And I actually want to repel the big bureaucracies
yeah,
and those people that are going to take 6 months to vet me. I'm not interested in those folks. I
yeah.
don't want to work with them. And my content is kind of designed to have that. And so far, I think it's working. I just don't know, is it because of that or is it just by accident? I don't have a way to know it, but that's an intentional. It reminded me when you said that of there's like subtle things you could do with your voice that get you the kind of clients you want.
Yeah, no, I agree with you. And I think that like I'm very similar in that way, right? Like I'm sure that I could bill Chase a lot of money, right? But I don't want to have to go deal with what I would have to deal with to do that. Um, no, and I think that that's something that I try to do too. You know, the other thing that's kind of hard for me is uh since this is going to be my therapy session, so thank you, Carlos.
Happy to provide it, John.
Uh legal and compliance is inherently negative. And I don't want to be just gloom and doom all the time. And I don't
Mm,
want to run a LinkedIn that's based off fear, uncertainty, and doubt. But then at the same time, there's an element of that to it, right? And so uh, that's a something I think about a lot too.
mm-hmm.
Is um, and I've got some plans in
Mm.
place to build some things about this of like educating, helping, not, oh my God, your world's about to end, right? because like that's not helpful. Like no, like I don't think that a lot of people, and I don't think the people that I want to work with are attracted to that either, right?
Mm.
Like because again, there's a lot of people that like if I wanted to go hear about how terrible things can go wrong, I'll just call my lawyer at the bank, right? You
Right.
know? So yeah, that's the other type tone thing that I think about a lot.
Yeah. No, it's it comes through in your content. Like you feel to me lighthearted. You make
Yeah,
jokes. I see the laughing emoji often on your content.
yeah,
I
yeah,
probably put some of those in there myself. Um, I am terrible with humor in social media. I'm horrible. Like I'll drop one every now and then, and like half of them bomb, and I probably
yeah,
delete them an hour in sometimes.
yeah.
But you're a little bit more consistent with it, and it does help kind of get the vibe
Thanks.
right. One other thing I'll point out, I think it's playing to your advantage. I know it helps me, but I wonder if you think about this much. Is we're both in regulated industries,
Mhm.
so banking, lending, etc. I would describe the industry as conservative,
Mhm.
very like almost. You could even go very conservative. And the people in the industry, for whatever reason, and many of these reasons are very valid, tend not to want to talk about what they do in public.
Mhm.
People hold their cards close to the vest. Like in my world, like the risk people
Yeah,
building underwriting models, they don't want to talk about the stuff they do.
yeah,
Um, Partially because they probably fear what their employers will think or do if they're sharing anything that could even be considered confidential information. As a result, there are very few people in what I do publishing with the frequency I publish in my niche. So like I don't view myself as having a lot of competitors for
yeah.
the service I provide and for the content I put out. Do you feel the same way?
I don't think there's a lot. I think there's a couple of people who would be quote competitors, right? That do put out some really good stuff. Um, I mean, I'll tell you this: like there's a guy in California. He's a lawyer. He works at a big national firm who
Mm-hmm.
does a great job on privacy stuff. And
Mm-hmm.
like, I literally messaged him Friday night, and I said, I don't know you, you don't know me. We know some of the same people. You got great content, and it helps me, so thank you. Right? Like, um,
You say it helps you
so
because it inspires you to raise your bar for your
it,
content,
I
or
would say,
how
well,
does that?
one, because he's in California, and so like he
Oh,
lives
so
and
it
breathes.
actually educates you. You mean?
Yeah, absolutely.
Yeah.
Like,
Okay.
yeah.
Got
So
it.
like, so he
Got
lives
it.
and breathes it, and he's like, hey, um, this case just came out, right? And these are like the three bullets. And I'm like, oh, well, thanks. Now I don't have to go look for it, right? So, um, it helps me when I do read that case to say, oh, okay, yeah. Like, is there anything else in here that helps my clients, right?
But if you
So
flip
like that,
that from his perspective, if you ever bumped into a potential client that he would be a good attorney for,
yep.
my guess is you'd probably be comfortable sending that
Oh,
person
absolutely.
their
Yeah.
way. Yeah. So
Yeah,
like they're
absolutely.
so I think that individual's probably getting something out of that as
Yeah,
well.
for sure. And then,
Yeah.
um, but yeah, like there's a handful of people, but not much, right? Like as you can probably guess, there's a legal LinkedIn, right? And um, we all kind of know who each other are, and so like that's interesting. But we're in different niches, so uh, yeah, I don't think there's a couple of people that are like my direct competitors. Want me bluntly, one of them my old law firm, right? So like I know what they're posting a lot, but again, that's kind of goes to differentiation, right?
Cool.
I think it would be
Cool.
a lot hard. Like, I don't think that you didn't ask this question, but like, I don't think it's as hard to differentiate myself from other people as it would be if I was like in just sales. Like, I think like there's 1,000 sales guys out there doing it, right? And like
There's
they're
probably
all
there's probably 50,000 of them. Yeah.
yeah,
There's a
and
lot.
they're all like variations on a theme. So
Yeah.
um, some
But
are
then it
good.
comes back down. But then it comes back down to what you said earlier. What's the exact niche?
Hmm.
What's the exact angle? What's the exact personality?
Yep.
Like I still think even in sales you could carve off little space there that's uniquely you.
Yeah. Yeah.
Although to your point, it's a lot harder. You got to go a little bit more micro.
Yeah. I think you do. I think that
Yeah.
like you have to be making it up, right? Like you have to be car sales in New Jersey, right? And
Probably even
whereas
more than that. Car sales. Yeah, I don't know.
car sales of
Southern
used,
New Jersey.
yeah, of used SUV, right? Like you
Right.
have to be
Yeah.
the Jeep Wrangler dealer in Southern New Jersey, right?
Right.
And here's how I can help you, right? Um, Whereas like my niche my niche is my niche, right? It just is. Like so therefore I've already like there's already that little circle. And then I'm like my wife, God love her, vaguely knows what I do for a living. Uh,
Mm.
and she's like, are there enough companies that they could pay? I'm like, yes, there's enough.
Yeah.
Like there's enough.
Yeah.
So
Yeah, no, I wonder about that too for my business. I mean, if I had to write a list of them, I don't think it's a huge list to be honest
yeah,
with you, but it's probably 100 plus
yeah,
companies.
yeah.
So it's not thousands.
No, it's
It's not
not.
tens of thousands.
No.
It's probably hundreds, low hundreds, somewhere like
Yeah,
that. But I only need a handful of clients active
yeah,
at once for it to make
exactly.
sense.
Yeah,
So that's
yeah,
what makes it interesting. Cool, John. Well, this was awesome. We could probably talk content all day, but
yeah. I could.
we've gone way over our time.
Yeah,
So I appreciate you indulging me here on kind of the B side of our conversation. Thanks so much. Where can people find you if they're interested in your practice or want to connect with you on LinkedIn? What's the best way for them
yeah.
to
The
reach
best way to
out?
do it is search for John Henson on LinkedIn. I'm easy to find there. I'm also available. I have a website that's coming available that I will be announcing on LinkedIn. So probably right now the best way is just pure LinkedIn.
Awesome.
Yep.
Cool. Well, John, was a pleasure to chat this morning. Took a lot of notes while we were going through this, and hope to share some of them out to the audience sometime
Awesome.
soon. So
Carlos. Thank you for
thanks
the
again,
opportunity.
John.
I appreciate it. Thank you for the opportunity.
If you want to support the show, the number one thing you can do is go to thefreetoaster.com and sign up for our newsletter. You're going to get a couple pieces per week of news, information, insights, and podcasts like the one you're listening to right now at the intersection of marketing, lending, and technology. That's our niche. We don't plan to go outside of that. It's the only publication I've seen out there on the internet that dials into this zone. So if you want to support us, sign up and share it in your favorite Slack channel.